Preparing for FP&A at Sempra interview? You've reached Candy Mentor, and this video is for you. We'll walk through 25 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does FP&A mean to you, and how would you add value at Sempra? FP&A connects operating decisions with financial outcomes. In this role, I would combine historical performance, operational drivers, and management priorities to build forecasts, budgets, and variance explanations. At Sempra, that could mean linking customer demand, weather, rate cases, capital investment, and project execution to earnings and cash flow. The value is not merely producing reports. It is providing an early, actionable view of performance, opportunity, and risk. While answering, focus on connecting operating decisions with financial outcomes, building reliable forecasts, explaining variances, partnering with business leaders, and providing forward-looking insights relevant to utilities, infrastructure, and energy projects. Question 2. How would you build an annual budget for a Sempra business unit? I would begin by understanding corporate targets, strategic priorities, and the business unit's planning calendar. Then I would gather assumptions from operations, commercial teams, human resources, procurement, and capital project owners. I would model revenue, operating expenses, labor, depreciation, financing impacts, and capital spending using measurable drivers. After consolidating submissions, I would challenge inconsistencies, run scenarios, review results with leadership, document assumptions, and secure approval before establishing monthly budget controls. Make sure to cover the planning calendar, top-down targets, bottom-up operating assumptions, revenue and expense drivers, capital spending, headcount, cross-functional review, scenario analysis, and final management approval. Question 3. Walk me through your approach to forecasting revenue for a utility or infrastructure business. I would separate revenue into its underlying drivers rather than extrapolating last year's total. For a utility, I would consider customer counts, usage volumes, weather, approved rates, regulatory recovery mechanisms, and seasonality. For infrastructure activities, I would analyze contracted volumes, project milestones, pricing, and timing. I would validate assumptions with commercial and operations teams, compare the forecast with recent actuals, and quantify sensitivities so management understands what could change the outlook. In your answer, talk about customer volumes, rate structures, weather, regulatory decisions, contracted revenue, commodity exposure, seasonality, historical trends, operational input, and sensitivity analysis. Question 4. How do you perform a meaningful monthly budget versus actual variance analysis? I start by identifying material variances and separating timing items from genuine changes in business performance. I then decompose results into volume, price, mix, rate, productivity, headcount, and one-time effects. I reconcile unusual movements to source data and discuss root causes with the responsible business owner. Finally, I determine whether the issue requires an accrual correction, forecast revision, or management action, and present the conclusion clearly rather than simply listing unfavorable numbers. Be sure to mention materiality, timing versus permanent differences, volume and price drivers, accruals, ownership, root cause investigation, forecast updates, and concise communication of actions. Question 5. What is the difference between a budget, a forecast, and a long-range plan? A budget is an approved operating commitment for a defined period, usually with detailed monthly targets. A forecast is an updated estimate of what the business now expects, incorporating actual results and changed assumptions. A long-range plan looks several years ahead and connects strategy, capital needs, financing, and earnings capacity. I would use the budget to measure accountability, the forecast to support decisions, and the long-range plan to evaluate strategic trade-offs. While answering, distinguish each tool's purpose, timing, level of detail, refresh frequency, strategic horizon, ownership, and role in performance management and capital allocation. Question 6. How would you forecast operating expenses when historical spending is volatile? I would not rely on a simple historical average. First, I would identify one-time events, timing distortions, accrual reversals, and unusual project costs. Then I would forecast recurring expenses using drivers such as headcount, maintenance activity, vendor contracts, inflation, and expected work volume. I would review open commitments and planned initiatives with cost owners, compare the result against historical run rates, and provide base, upside, and downside cases where uncertainty is significant. Focus on separating recurring and non-recurring costs, using operational drivers, reviewing commitments, considering inflation and contracts, consulting budget owners, and applying scenarios rather than blindly averaging history. Question 7. Which financial statements and metrics are most important in FP&A? I would use all three financial statements because earnings quality and liquidity can diverge. The income statement shows profitability, the balance sheet highlights working capital and investment, and cash flow shows funding capacity. Depending on the business, I would monitor EBITDA, operating cash flow, capital expenditures, free cash flow, leverage, and return on invested capital. For Sempra, I would also connect financial metrics to customer growth, project milestones, reliability, and regulatory recovery. In your answer, cover the income statement, balance sheet, cash flow statement, EBITDA, operating cash flow, capital spending, liquidity, leverage, return measures, and business-specific operational KPIs. Question 8. How do the three financial statements connect during forecasting? The income statement provides net income, which flows into retained earnings on the balance sheet. Forecast depreciation affects both earnings and the asset balance, while capital expenditures increase fixed assets and reduce cash. Working capital assumptions connect operating activity to cash flow, and debt schedules capture borrowing, repayment, and interest. I would ensure the balance sheet balances and cash flow reconciles, because integration exposes inconsistent assumptions that a standalone income statement can hide. Make sure to explain net income flowing into retained earnings, non-cash expenses, working capital movements, capital expenditures, debt, cash balances, and the importance of a fully integrated model. Question 9. Describe a financial model you would build for a major capital project. I would build a monthly project model covering construction milestones, procurement costs, labor, contingency, financing, commissioning, and the operating ramp-up. The model would calculate depreciation, taxes, maintenance costs, revenue or regulated recovery, and project cash flows. I would include base, delayed completion, cost overrun, and lower utilization cases. Outputs would include total investment, cash flow timing, return measures, funding needs, and potential earnings impact, allowing leadership to evaluate both economics and execution risk. Be sure to mention construction timing, costs, financing, operating ramp-up, depreciation, tax, regulatory or contractual recovery, cash flow, sensitivities, and investment decision metrics. Question 10. How would you assess whether a capital project is on track financially? I would compare incurred and committed costs with the approved budget, while tying spending to physical progress and milestone completion. I would calculate the estimate at completion, review change orders, assess contingency consumption, and investigate schedule slippage. I would also compare expected benefits or recovery with the original business case and update cash timing. If the forecast worsened, I would quantify the impact, identify mitigation options, and escalate early rather than wait for a budget miss. Discuss committed versus incurred costs, schedule progress, estimate at completion, contingency usage, change orders, cash timing, benefits realization, and escalation procedures for emerging risks. Question 11. What financial impacts can a utility rate case have, and how would FP&A model them? A rate case can affect revenue, allowed operating costs, capital recovery, depreciation, financing, and the timing of cash collection. I would model the requested case, likely outcome, and downside scenario, incorporating the proposed rate base, allowed return, customer growth, operating assumptions, and effective date. I would also consider regulatory lag and whether recovery occurs immediately or later. The output should show impacts on earnings, cash flow, capital funding, and key management decisions. Focus on authorized rates, test year assumptions, regulatory lag, allowed returns, capital recovery, operating costs, timing, customer demand, regulatory outcomes, and scenario-based earnings and cash flow impacts. Question 12. How would you analyze the effect of weather on financial performance? I would compare actual heating or cooling degree days with normal conditions and analyze how the difference affected customer usage and revenue. I would separate weather-sensitive volumes from fixed charges and other revenue components, then compare results with historical relationships. For forecasting, I would use normalized weather as the base case and show a range for warmer or colder conditions. I would clearly distinguish temporary weather impacts from underlying customer growth or operational changes. In your answer, cover heating and cooling demand, degree days, customer usage, normalization, seasonality, regional differences, historical relationships, and transparent communication of temporary versus structural effects. Question 13. How would you evaluate a forecast when actual results are consistently different from plan? I would measure forecast accuracy by line item and period, then identify whether errors reflect bias, timing, missing drivers, or execution issues. I would compare assumptions with actual operating data and speak with business owners to understand what changed. If the model consistently overstated demand or understated costs, I would recalibrate the drivers rather than simply adjust the final number. I would document lessons learned and use rolling forecasts to improve responsiveness. Mention forecast accuracy metrics, assumption review, bias detection, driver-based reforecasting, feedback from operating teams, model recalibration, and distinguishing execution problems from unrealistic planning assumptions. Question 14. Tell me about a time you improved a reporting or forecasting process. In a prior project, monthly reporting required several manual spreadsheet consolidations and often produced inconsistent totals. I mapped the process, standardized account and department inputs, added validation checks, and created a repeatable reporting template. I partnered with accounting and budget owners to test the output and document responsibilities. The process reduced preparation time, improved traceability, and allowed discussions to focus on business drivers instead of reconciling avoidable errors. I would bring the same continuous improvement mindset to Sempra. Be ready to explain the original problem, your analysis, process redesign, stakeholder collaboration, controls, measurable time or accuracy improvement, and how you ensured the solution remained sustainable. Question 15. How do you ensure data accuracy in an Excel-based FP&A model? I begin with clearly defined source data and reconcile key totals to the general ledger or approved operational reports. I separate inputs, calculations, and outputs, avoid hardcoding where possible, and use consistent formulas. Balance checks, variance flags, cross-footing, and reasonableness tests help identify errors. I maintain version control, document assumptions, and ask another reviewer to challenge the model. Before distribution, I test both the formulas and the business story the numbers communicate. Be sure to mention source reconciliation, standardized inputs, formula discipline, checks, version control, review procedures, documentation, access controls, and independent reasonableness testing. Question 16. Which Excel functions and tools are most useful for an FP&A analyst? I regularly use SumIfs, XLOOKUP, index match, if logic, date functions, pivot tables, and conditional formatting. For larger recurring files, Power Query can standardize and refresh source data efficiently. I also use charts and waterfall analyses to communicate variances, while scenario tables show sensitivity to key assumptions. My priority is not using complex formulas for their own sake. It is building a transparent, auditable model that another analyst can understand and maintain. Discuss SumIfs, XLOOKUP or index match, if logic, date functions, pivot tables, charts, data validation, scenario tools, Power Query, and model transparency rather than function memorization. Question 17. How would you use Power BI or another visualization tool in FP&A? I would use Power BI to combine approved financial and operational data, automate recurring refreshes, and give managers visibility into actuals, budget, forecast, and key drivers. A useful dashboard might allow users to drill from enterprise results to business unit, project, or cost center. I would establish clear metric definitions and ownership before publishing it. Visuals should highlight exceptions and decisions, not overwhelm users with charts that lack actionable context. Focus on automated data refresh, consistent definitions, KPI visibility, drill-down capability, exception reporting, audience needs, governance, and using visualization to support decisions rather than create decorative dashboards. Question 18. How would you explain a complex unfavorable variance to a non-financial executive? I would lead with the conclusion, the variance, its size, and whether it changes the full-year outlook. Then I would explain the main business drivers in plain language, such as lower volumes, higher contractor costs, or delayed project recovery. I would distinguish timing from permanent impact and identify what management can control. I would finish with the recommended action, owner, and next review point, supported by a concise bridge or waterfall. Mention leading with the headline, translating accounting into business drivers, quantifying each cause, distinguishing controllable and uncontrollable items, stating the forecast implication, and recommending next actions. Question 19. How do you prioritize competing requests from senior stakeholders? I prioritize requests based on decision impact, deadline, materiality, and dependencies. A forecast needed for a financing or executive decision would generally take precedence over a lower impact presentation enhancement. I would clarify the required output, agree on timing, and communicate trade-offs early if resources are constrained. I also look for reusable analyses rather than one-off work. If priorities genuinely conflict, I would present the alternatives to my manager and seek direction. In your answer, discuss urgency, decision impact, deadlines, materiality, dependencies, effort, transparent communication, expectation management, and escalating conflicts when priorities cannot be reconciled. Question 20. How would you partner with accounting during the monthly close and forecast cycle? I would establish a clear close calendar and understand which actuals, accruals, and estimates are available at each stage. I would reconcile significant forecast inputs to accounting records, investigate unusual entries, and discuss cutoff or classification issues with the controllership team. Before forecasting, I would confirm the latest actuals and recurring run rates. Strong partnership matters because accurate accounting creates the foundation for credible analysis, while FP&A adds forward-looking interpretation. Cover close calendars, accruals, actual versus estimate differences, account reconciliations, unusual entries, shared definitions, forecast handoffs, controls, and respectful resolution of disagreements. Question 21. What would you do if a business leader submitted an overly optimistic forecast? I would first understand the assumptions and the operational evidence supporting the leader's view. Then I would compare them with historical performance, current run rates, capacity, contracts, project status, and external conditions. I would present a base case, the submitted case, and the risks required to achieve the upside, rather than dismissing the estimate. If the difference remained material, I would document both views and escalate transparently so leadership could make an informed judgment. Be sure to mention respectful challenge, evidence-based assumptions, historical performance, operational capacity, independent scenarios, alignment with incentives, and escalating unresolved material differences professionally. Question 22. How would you analyze a sudden increase in energy or commodity costs? I would separate the increase into market price, consumption volume, timing, and contract or hedge effects. I would review whether costs are recoverable through tariffs or customer contracts and determine when recovery occurs. I would compare actual market movements with the forecast assumptions, assess weather and operational drivers, and quantify earnings and cash flow exposure. I would then update scenarios and communicate both the immediate variance and the potential full-year impact. Discuss price and volume decomposition, hedging or contract coverage, pass-through mechanisms, timing, weather, market data, customer impacts, cash requirements, and updated scenarios. Question 23. What KPIs would you track for a utility or infrastructure business? I would balance financial outcomes with operational indicators. Financial KPIs could include EBITDA, operating cash flow, capital spending, free cash flow, leverage, and forecast accuracy. Operating measures might include customer growth, demand, cost per unit, project progress, utilization, reliability, safety, and outage performance. For regulated operations, regulatory milestones and rate base growth are important. The right dashboard should explain why financial results changed and whether the underlying business is becoming stronger. Include financial and operating measures such as customer growth, demand, reliability, safety, cost per unit, capital progress, project returns, cash flow, leverage, and regulatory performance. Question 24. How would you prepare for an executive forecast or performance review meeting? I would validate the latest actuals, forecast assumptions, reconciliations, and key movements before preparing the materials. I would develop a concise bridge from plan to actual and forecast, identify the 3 most important messages, and quantify risks, opportunities, and required actions. I would pre-wire material issues with business owners and anticipate likely questions. In the meeting, I would lead with the conclusion, answer directly, and keep supporting detail ready without overwhelming the audience. Focus on validating numbers, identifying the headline messages, preparing variance bridges, anticipating questions, aligning with stakeholders, highlighting risks and actions, and tailoring detail to the executive audience. Question 25. Why do you want to work as an FP&A analyst at Sempra? Sempra interests me because it combines essential infrastructure, regulated utility operations, and long-term energy investment. That creates a demanding FP&A environment where forecasts must reflect operations, regulation, capital deployment, and changing market conditions. My strengths are structured analysis, attention to detail, and communicating financial implications clearly to non-financial partners. I would value the opportunity to support disciplined investment and reliable service while developing a broad understanding of a complex energy company. In your answer, connect your analytical strengths and interest in infrastructure or energy with Sempra's scale, regulated and growth businesses, capital intensity, energy transition, stakeholder focus, and opportunity to influence decisions. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.